Cash is trash. Well, is it for the average investor? Well, cash is trash if you listen to the billionaire hedge fund manager Ray Dalio of Bridgewater Associates. Yes, Mr. Dalio started using that catchy phrase quite a few years ago, but he became notorious for it when he pronounced it from on high, both literatively and figuratively, on January 21st, 2020, amongst the business and political elites in the mountains of Davos, Switzerland, at the World Economic Forum. And then what happened? Well, COVID hit and the S&P 500 dropped over 30% in just 4 weeks. So, is cash trash for the average investor? I'm Chris Parrish, Chief Investment Officer at Oak Harvest Financial Group, and I want to address the notion that cash is trash for investors other than billionaires or 100-year time horizon endowments and pension funds that Mr. Dalio markets his funds to. I can't argue with the basic premise behind Mr. Dalio's proclamation. He makes good arguments for calling cash trash. His basic rationale has been that mushrooming money supply and government money printing caused by our deficits would eventually bring on inflationary pressures and a weakening of the dollar. Well, after 30 years of deflationary pressures caused by 1. Rapid technology adoption, 2. Us outsourcing our production and labor to cheaper continents, and 3. The morphing and aging demographics here in the United States, a combination of Federal Reserve-based stimulus and money printing coupled with supply chain disruptions and an acceleration in baby boomer retirement, look to have finally inflected long-term inflation rates up above 2%. Does the investment team at Oak Harvest subscribe to Mr. Dalio's cash is trash declaration? I'll let you know shortly, but give our team a call here at 877-896-0040 and give our investment team a chance to help you with your investment allocation. And give our financial planning team a chance to model your cash needs and greeds into and through your retirement years. Whether your cash account is yielding a few basis points or a few percentage points, the team at Oak Harvest is here to help you navigate into and through your retirement years. So the question is cash trash? If you've ever taken an economics class, you know that inflation is a tax. It's a tax on savers. It's a tax on those holding cash and other fixed income instruments. It's a tax on any asset that does not have pricing power to raise prices and offset inflation, or 2, maintain a utility use on its own, like a basic industrial commodity. Maybe inflation is a consumption tax in reverse. How is that? It's a tax on deferring consumption. If you don't buy that goods or service today, it might cost you 5 or 10% more next year. In a hyperinflation world, people see 100 to 500% inflation moves and crashing currency values. Venezuela and Turkey are the most recent examples of this. We aren't talking about that kind of inflation here in the United States, and our team does not subscribe to the 1970s type of inflation either. But we are now running much higher than the Fed's 2% inflation goal. In Mr. Dalio's world, both TINA, T-I-N-A, which stands for there is no alternative to equities, and FOMO, F-O-M-O, that's fear of missing out, rule the day in unison, and no rational investor would, 1, carry an investment cash allocation in their portfolio, as you would be guaranteeing that you lose money versus inflation. In the finance world, you would be surrendering to a negative real return. So in Mr. Dalio's asset allocation scheme, you would be 100% invested in something other than cash at all times, every day, every week, every month. You would be all in. Chips in the middle of the table, let the good times roll, volatility be damned. Opportunity to buy on the downside market, not possible because you have no cash. In Mr. Dalio's world, the greed factor seems to far outweigh one's need level in an investment and allocation equation. Viewers, this might make some rational sense to Mr. Dalio personally. He's a billionaire and does not need cash to pay bills. What bank in the world wouldn't lend him a little money to meet his monthly needs? What firm wouldn't advance him cash to buy an asset if he came to them and said, I saw a great deal on a mispriced security? And viewers, this cash is trash strategy might make sense to Bridgewater's investor base, who are largely endowments with 100-year and longer time horizons, or pension plans whose liabilities are measured in decades. I remind viewers, clients who are institutional in nature, not retail like you and I, and to whom Mr. Dalio is charging a hedge fund fee structure for a risk parity strategy. In other words, it would be really tough for him to charge clients 2% and 20% of the profits if he's sitting around with a lot of cash. However, in few worlds, in my opinion, is cash trash. In very few worlds do older investors not need bonds or bond alternatives. In very few circumstances is it smart to be, I'm 100% long equities or other assets as a retiree or near retiree. And I would argue this cash is trash theory makes little sense to the rest of us, the other 99.9% of us investors who are not billionaires. Mr. Dalio's Davos cash is trash call on January 21st, 2020 could not have come at a worse time. It could go down as one of the worst market timing calls in the last 30 years. His hedge fund then suffered a minus 20% loss in the first quarter of 2020. He's made follow-on calls like this each of the last 2 years, and amazingly, each time he has, within a period of 1 to 7 days, the market has declined 5 to minus 12.5%. Cash is trash, and poof, here comes a pullback, correction or bear market in stocks. Each time he's been center stage saying this. Equally interesting to me is that despite Mr. Dalio's ongoing calls of cash is trash for years, Bridgewater's Pure Alpha 2 hedge fund, according to Bloomberg, has returned a paltry 1.6% net of fees for the last 10 years in one of the biggest bull markets in 100 years. The Orange County Retirement Fund puts Bridgewater's return at plus 4.5% per year since 2005. But that's lagged its benchmarks by about 2.5 percentage points per year. When it comes to thinking about discussing and using cash or even bonds as an investment category, the team at Oak Harvest would much rather look toward another billionaire investor for an appropriate model. Who's that? That would be Warren Buffett. As of last count, Mr. Buffett's company, Berkshire Hathaway, had over $135 billion in cash and short-term investments that include short-term bonds with which interest rates have been rising over the past 9 months. Mr. Buffett probably is showing small capital losses on those bonds like all retailer investors are. Recall that Berkshire Hathaway is in the business of buying other companies. Mr. Buffett is Berkshire's largest shareholder, and Berkshire does not charge its shareholders performance fees like a hedge fund. Mr. Buffett has been quoted in a shareholder's letter as saying this: "I will never risk getting caught short of cash." Why does he say this? I believe it's for 2 reasons. First, it's probably because Mr. Buffett, while he does not need a dime of cash, given his net worth, knows that having some cash lying around in the form of short-term liquidity instruments or short-term bonds as an investor is a call option in things going bad for other people. It allows one flexibility to jump in on opportunities and others' mistakes when misfortune comes to town or the overall economy hits a recession. And secondly, and probably more importantly and less talked about for pre-retirees and retirees, is that Mr. Buffett knows that the sequence of investor returns is almost as important to an investor as one's total compounded return, especially for those nearing or in retirement. Is cash trash? Not in my book. With the continued volatility that we expect, our investment team recommends that you get on the phone and give our Oak Harvest team a call at 877-896-0040 and ask to speak to one of our financial advisors and planners. Set up a meeting or two and sit down with one of our team and let us walk you through how the sequence of returns can affect your retirement plan every bit or more than your average investment return that your current advisor is generating you. I'm Chris Paris, and from the whole team at Oak Harvest, have a great weekend.